Hi, this is Randy Finney with the Right Side of the Chart, and today is Thursday, July 23rd, 2020. What we're going to do in this video is take a look at some of the agricultural commodities I've been highlighting recently. I still believe that arena has some of the best risk-reward profiles out there of the various asset classes. An asset class would be securities or stocks or one asset class, bonds or fixed income or another asset class, commodities, and even within the commodities arena you have various types, hard, soft, you have your agricultural commodities, um, and industrial metals, all other things like that. So we're going to look at the agricultural commodities. That's where I've been really focusing on lately. And I want to just paint kind of the bigger picture. So all we're going to do right now in this video, keep it relatively short. Not going to go into all the time frames, all the different vehicles. I do post frequent coverage of the ETNs that track these commodities. Usually it's going to be an ETN. Sometimes you'll have an ETF, and as well as futures. So what we're going to look at in this video is just the charts of the futures, and I'm painting the bigger picture, and also the not just I've made the case for objective entries, buy points. I continue to update that. We have some official trade ideas on some of the ETNs, unofficial trade ideas as well. And I'll continue to highlight, pullbacks to support as objective entries, breakouts above resistance, things like that. But this is going to paint the bigger picture, and just keep in mind what we're looking at here are the futures contract, what we call the continuous contract, where they loop together. Futures will have an expiration date, and so what they're doing is just really splicing the various futures over time. And this is the really the pure play, how to track the price of sugar or wheat or anything like that. You want to look at the futures. Again, the ETNs do a pretty darn good job of tracking, so there's nothing wrong with that, and I'll always make those the official trade ideas, because I understand that some traders don't have the experience, understanding of how futures work. They might not have access to a futures account, period, or the capital requirements, because futures are leveraged, and so typically you need you can get in with a much smaller amount on an ETN that tracks these futures. Okay, with that being said, we're going to start out in no particular order, just how I have them listed on this charting platform. And this is sugar futures. Keep in mind, these are all, as I'm going through this, I just want to point out, these are stockcharts.com, at least that I'm working off here, will give you only end-of-day prices, so they're going to be as of the close yesterday when you see the price. These are not going to be streaming right now in real time. But that doesn't matter because I'm painting the bigger picture here. All right, so on sugar, what we have, what stands out most importantly, is this big positive divergence at the recent low. I pointed out back here a few months ago we had positive divergence. We're going to go back in time, and I also want to add this. I remember a few weeks back, somebody on the site, when I started picking up on these commodities recently, said, hey, can you post more on the stock market? Commodities are, in other words, I can't remember if they thought the return potential was too low. If they're thinly traded, the ETNs can be, even some of the futures are thinly traded, but that's not a problem because they're tracking something that has a tangible value. It's a big difference of trading a thinly traded penny stock or any stock for that matter, because the value at any point in time is subjective to what the market thinks it's worth. And if you get in a thin stock, it can, the company could have great fundamentals, it could be growing, but if there's not a lot of people trading it or believing in it, that stock can stay down or can be hard to exit. Bottom line is, when you're trading the ETNs or even futures for that matter, there are a couple ways. If it is thinly traded, meaning you don't see a lot of volume, the bid and the ask tend to be big, split the difference. Go in the middle. If they don't fill your order, maybe raise it a little bit closer to the ask price if you're trying to buy. But again, at the end of the day, if soybeans rise 30%, the soybean ETF should go up 30%. You just might not have that, very tight bid and ask, and so it's best not to use market orders on any thinly traded security, whether it's a futures contract, a stock, or an ETF or an ETN. Interactive Brokers has a IB Algo program, they call it, or an order type, I'm sorry, it's called IB Algo. You enter the order and they will automatically fish the order around between the bid and the ask, and using their algo programs trying to get you the best fill. I like to use that on futures, and and even stocks or ETFs that are not actively traded. Okay, so with that being aside, I think that's important because there is that. I do need to mention that. Sometimes I forget to mention that, and if you're new to trading or investing, you might see some of these, especially the ETNs that track some of these commodities, just don't have a lot of volume. So just be careful because on a market order they can fill you wherever they want. All right, that's that. What are we looking at here? We had back at this point in time, we had positive divergence, and these are the things I look for. I was pointed out, and that led to, from that point, a rally of 55%. I don't know if you can make it here in the box. And so that was a 55% rally in sugar from that point up to this point. Now, what happened since then, you might say, okay, well, that was a nice gain. First of all, I wanted to point out that 55% rally happened over just about a year. We'll call it a year and a half. Not too bad. 55% return in about 18 months. You can see the year breaks down here. Now, what happened since then? It went on to put in a new low after that 55% rally. And that new low put in a much larger more powerful divergent low. It's really the same divergences, just extended because we're coming off the same point there. And so this tells me, just based on that alone and the fact that you can see sugar has a long-term support line right here, this tells me the next move up is likely to be much larger. And we go back in time. Last time we had positive divergence before that was right here. And you can see I measured it out. That was good for about 140% rally right here. That's the measure. I don't know if you can make it out in the video. There's a measuring tool. These little dashed lines, I already measured it out. So about 140% rally. I often talk about how divergence in itself is not a buy signal. You look for things such as breakouts when you're going long, a breakout above resistance, or a pullback to support. Those are your objective long entries. And we had a breakout. So your next, if you missed it, then you had an opportunity here, or if you took a partial position, you had an opportunity to add on the back test of the downtrend line, your primary downtrend line right here. Okay, time before that, going all the way back to 2007. That was the previous divergent low right there, and that was good before all is said and done for a rally of about 320%. From this divergent low, you started an uptrend that ended with this divergent high, and started the new downtrend. So there it is. So we're going back in time to all the way back to the early 2000s, and you can see we've had 1, 2, really 3, because this is an extension, divergent lows. The other 2 preceded bull markets, and that's what we're looking at here. So I wanted to impress the point that I have near-term targets on a lot of these trades, short-term targets that very much have the potential. All of these trades, or most of these, I'll try to convey my thoughts, I'm viewing as potential long-term trades. A long-term trade to me, you can use different terminology, either a trend trade or an investment, where this is, if I had to put all my money into, let's say, 5 or 6 things right now and then sail around the world for a year without any internet access or way to, I would 10 times over rather put it into these commodities than I would into the equity market. And that's just me. Doesn't mean that they're guaranteed to go up and the stock market's guaranteed to go down or not go up as much. It just, again, risk reward profile, no financial shenanigans, Fed manipulation, cooking the books on earnings, using, all kinds of fancy companies right now are taking advantage of everything going on with COVID, just like that latest on Wells Fargo yesterday, trying to force people into these mortgage deferral payment things. I'm sure I didn't read all the fine print on it yet, but I'm sure they're probably getting tax breaks there, and Wells Fargo has a history, that kind of stuff. So again, these are a lot of financial shenanigans that can happen in the equity markets, but these are commodities. These don't go bankrupt. They don't file for Chapter 11 bankruptcy protection. They don't have a CEO who was doing some involved in some scandal. They are not cooking the books. That's that. So let's move on to the next one. And again, the takeaway from this is this divergent low right here, and it looks to me good chance that this is the beginning of the next leg up that will take out that high and maybe embark on a bull market like this previous 140% or 320% bull market. I'm going to run through the rest a little bit faster because most of what we're looking at here It's the same thing. I'm looking for these divergent highs and lows. You can see them all on this chart, history of divergent highs and lows right here. You get the divergent lows. In this one right here, you had a bull run measured out right here. That's 68% off that divergent low. Next divergent low was right here. That was good for up to this point right here, from here to here. Well, you can see in the middle right here where the arrow is, that's about a 48% bull run right there. And again, I'm looking at the divergences down below. 1, 2, 3. Wash, rinse, repeat. Could this time be different? Possibly, but this is, well, big part of my trading style. I look for not just divergences, look at where it's at when the divergences happen. In this case, I can see a pretty good support level. Way back here in 2017, I mentioned this. You can see these are the notes from the time. Cocoa poised for a sharp rally up to any or all of the horizontal lines above. I had two at the time, just these two, with a breakout to come on a break above this steep falling wedge. There was our breakout. There was our rally hit. I don't know what that was on, but I know those were each easily double-digit gains right there. It went in, put a new marginal new low right there, larger divergence, and that was it. That was the bottom before that 68% bull run that lasted from looks like 2017 up until about 1 year. So about a 70% return over a year. This one was 48%, and that was over a period of about the same, a little more than a year. So that's what we could be looking at here. Potentially the next bull trend that lasts for a year or more, and looking at just the previous two, you're talking about an average of about 60% right there. And this is coffee, one of my favorites. Coffee, when it wants to run, it can run. And again, so whereas, I say this quite often, you go to the cocktail party or, it's a water cooler talk at the office. Everyone wants to talk about Tesla. Tesla's on fire, electric cars, Elon Musk changing the world. Or you want to talk about the latest, biotech stock working on the next vaccine for COVID and how that could explode if they hit, or this, amazing tech company with this new AI. That's the interesting. Those are the, again, cocktail party or water cooler talk. Nobody wants to talk about corn, wheat, or coffee. But, as an investor and a trader, I like to go where the opportunities are, where money can be made, and where the risk-reward profile look good. Coffee is one of those. Coffee, when it trends big. This right here, okay, so we're going through the chart. We had a divergent low back here, note 1, and then a trend line break. There's your buy signal. That set up this uptrend. To this peak right here, to this divergent high right here, and that would have been your heads up, hey, maybe book some profits in the trend. That measured to about 295% right there. And that was over a period of, it was several years, but still near about a 300% return. There was a correction, but it was within an ongoing bull market that didn't peak till right here. The total run, again, from this divergent low in '02 to the end of the bull market back there in early 11, that was a 622% rally right there. Then you you put in a divergent high. That was your kind of, hey, heads up, get out. That's a kind of a blow off top. You can see that parabolic run, clean up trend line. There was a sell signal to exit the trend. Have your stops there, turn around and reverse to a short. Get ready for the next bear market. And I didn't measure the drops, but they're pretty substantial. And again, it's all wash, rinse, repeat stuff. Wait till the next divergent low sets up. That's right here. I'm kind of missed that line there. There's your bullish divergence. Nice, clean, well-defined downtrend line, bullish falling wedge. Hard to miss buy signal right there. Boom. And I would venture to say we were in coffee at that time. I believe I've swing traded this one for years, and go back on the site. We probably got in and caught most or all that run, or at least a good part of it, maybe not all of it. Oh yeah, there it is. There's my notes. So we were able to milk a good part of that run right there. We got, I think, 110% gain off that. Went up a little higher, and that's it. Divergent high, correction. So this is kind of, again, the bigger picture stuff. This is a long-term chart. This is a weekly chart, meaning weekly candlesticks. We're going back 2 decades, and kind of, simple stuff. If you take a long-term approach, you're looking at bull and bear trends, bull and bear markets in coffee, and there's been quite a few. This has been in a bear market, but starting back here, earlier, it was in 2019, I started pointing out these divergences. We had a divergent low, and at that time I was calling for a 60% rally initially, with a pullback followed by a 90% run. We went on, we hit my 60% target, we broke out. Again, there was your buy signal, objective long entry, hit that target, pulled back, but remember, we're coming off that divergent low right there. If coffee, if it doesn't play out this time or pan out, and it takes another jog down, then all that's going to do, I'm not going to throw in I mean, I may stop out of the trade if the trade stopped out if it goes that low, my own personal trades or whatever we have on the site. But if that happens, you can see we're simply going to extend the divergences. So coffee, to me, has either bottomed, and I'm leaning that way, that we'll probably embark on the next leg up. It is an active trade. 90% would be, that run from that breakout point would be my next target. It's not an arbitrary level. It's resistance, reaction highs, several reactions there, and then quite possibly more. I think behind that note is another potential longer-term target, if I'm not mistaken. Yeah, it's on this line right here, wherever that is, about 220 or so in coffee. So this is my preferred scenario right here. And because of everything going on in the shorter term charts, which I'm not covering in this video, remember this is a long-term weekly chart, and should coffee fizzle out, take another leg down, no problem. I'll just revisit it maybe a few months down the road, a few weeks, a few months down the road, and look for the next buy signal. If we extend, I should say, not put in, but extend the divergences. We'll go down a little shorter in time frame only because I had the chart up next. And this is the daily chart. We were just looking at weekly candles, a longer term chart. So this one we're looking at daily candles. And again, just simple stuff. Look for these divergent highs. Time to get short or get out of your longs. There's other patterns besides falling wedges. Here was a rounding bottom pattern, led to this rally, divergent high. You can see all these are notes from the past. These were swing trades on coffee, and official, unofficial, some of those coffee futures here. And it trades well to the technicals. That's also what I'm getting at. Less manipulation than the stock market. Nice clean downtrend line there. Look at that breakout, boom. How much was that? If you caught that breakout right there from the point of the breakout, measuring it up, that was a 25% run in just a matter of looks like a few weeks there. So again, coffee might sound boring, but as a trading vehicle, it can post some nice double and even triple digit gains when it wants to run. And again, it trades pretty well to the technicals. Look for these divergent lows, wait for your buy signal, jump in, hit your targets, get out. Hit and run. This is swing trading. This is the difference of investing. An investor in coffee would have been losing tons of money for years now if you were long coffee. However, because it's been in a bear market. However, there's been a lot of profitable swing trading ops, and that's what this site is mostly about, swing trading. I'm also making a case for some potential longer term bottoming plays when I go to those weekly charts we're looking at. But here it is, divergent low rally, divergent low rally. I mean, I don't know. It doesn't to me get much easier than that. Doesn't pan out every time. That's the thing. You can't go put all your eggs in one basket and everything into this. It's just where to put some cash at this point in time in both swing trading opportunities as well as long-term investments or trend trading opportunities if you're a long-term investor, or like me, both. I have IRAs and college funds for my kids and long-term accounts, and then I have active trading accounts, and I'll do both, wear both hats. And this is corn. Corn's been lagging behind. Usually a lot of these, the softs and the grains, they tend to move together often, usually. So far we've pretty much a failure to launch in corn, but it is setting up nice. So what we're looking at here, I'm going to just highlight real quick. We are on a, let's see, this is a weekly chart, weekly candles. We're going back 20 years. This is to the late 90s actually, a little over 20 years there. And you can see divergent low, and that divergent low was followed by up to, what was it, this point right here to this high. That was a rally of a bull run of about 316%. And if you count it, because you bottomed here, you had the divergent low, even though there were some corrections in there, and they were tradable corrections. That's the thing. You can see these divergent highs. See the divergent high? Hey, maybe you want to get out, take profits, reverse to a short, buy back in on a pullback to support. And so, if you can swing a trend that before all is said and done, up to this point, again, from this bottom with the divergent low to there, that's where that bull run ended and started a bear market. That was a 346% run. But even if you don't short and you just took profits when you started seeing the divergence, waited for sell signals, of course, trend line breaks, things that you may not see on this chart, but you'd see on a daily or a 60-minute chart, time to get out, raise your stops. You could have sidestepped a lot of these givebacks, bought back in, and then magnified your gains. So on a bull run of 350%, you may have, total done 4, 5, 6, 700%. And if you're a flexible trader and you short, you see these divergent high blow off top, and that was a huge drop. It's many times that if you were able to successfully swing. You don't have to catch it all top to bottom, but if you catch the bulk of a run like that, and that's usually what I do. I'm usually in close to the tops and bottoms. That's just my trading style. It's a little aggressive, and I try to catch tops, try to catch bottoms. Sometimes you try to catch a top or a bottom, especially in something moving fast. You get some fingers cut, if you try to catch a falling knife. But as long as you keep your stops in place, if you were to have shorted it here and you had an appropriate stop above and it was a false signal, then you're not going to get burned. And again, trading's all about probabilities. Nobody bats 1,000, not even close. But if you can get in on some of these, get out on these divergent highs, short, go long. But I just wanted to bring this one up to speed where we're at. We've been building divergence here on corn for a long time, and corn looks to be in this basing pattern. I've had for a long time here R1 zone, that's a resistance zone, and then minor resistance right here. So here's what I see when I look at the chart of corn right now. I see what appears to be a potential basing pattern. There's some long-term support here. There was a reaction high, reactions here, and that's really, so going back for many years, well over a decade, almost 2 decades, corn is trading above long-term support, and it's bouncing. It keeps running into the top of this resistance zone, had a little false breakout there, but we have bullish divergence. So I can say it is objective to go long at support. We're down at the bottom of the trading range, so I can tell you it's objective to go long with a stop somewhat below the recent lows, and at minimum swing to the top of the range up here. Starting to get this chart, it's getting a little cluttered, but swing to the top of the range. Or as a longer term investor, if you continue to see traction in the ag commodities in general, especially with the other grains moving up. You want to see soybeans and wheat moving up, because corn, soybeans, and wheat tend to move together. They're obviously different things, but they're again, because of that relationship for both in food for humans, livestock, grain, feeding livestock, things like that. If the price of soybeans or corn or wheat goes up too much, then people are going to start buying corn as an alternative, or farmers might, because the prices are down. And so there it is. So that's it. Looking for a swing up there, minor resistance halfway, and then finally, if we break out, especially after that divergent low, that would most likely mean we've entered a new bull trend. And with a multi-year basing pattern like that, that could be pretty powerful. So there it is. That's corn. And then finally, we'll wrap it up here with soybeans. Soybeans, this one's a daily chart. SOYB is the symbol on stockcharts.com. They always put a $sign in front of the futures. Divergent low right there, and it's not really going very far. I mean, there was a decent rally up to that trend line, but this is what we need to do. We need to break this trend line right here, and that bring us up probably at least to this 1050-ish, about 1060 level right there. Yeah, that's it. There was our last divergent low. It was good for this swing trade up to that trend line. There was our previous divergent low, good for a swing trade up to the trend line. And maybe we remain in the downtrend. So again, this would be a longer term buy signal if that breaks. Let me see, I think I have one more on soybean. Let me see what my weekly looks like. That's one weekly. I've got a couple boards here. There's another weekly. Same thing. Okay, you can see that trend line and the divergence that was in place at that recent low. And like some others that I focus here, if we take another jog down and it's just a marginal new low, well, that's only going to extend the divergences that are already in place and then set the stage for maybe an even larger rally once, if and when that trend line's taken out. All right, I'm going to wrap it up here, and I'll follow up with a couple individual trade ideas outside this ag arena. I'll follow up with that later today. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.